Okay, ladies and gentlemen, welcome to Macros with EI Inventories with your host Tony. Hopefully, you can hear me clearly. There wasn't any feedback or anything coming through. I did have a little bit of that coming through before I just started the stream, so hopefully you don't get any feedback. But EI Inventories, we got a bit to cover, so let's get right into it. Puya says with a fingers up with a peace sign to you too. EIA Inventories. So as I usually do, I go through what the release is, what to expect, what is the sentiment, and the deviations as well. So let's get into that. So what is the EIA release? So what it does is it represents the weekly change in crude, gas, and distillate inventories. Good day to you too, Scotch and Stocks. Represents the weekly change in crude, gas, and distillate inventories. And what it affects the most in the economy is transportation, and also affects consumer prices for a number of products too. And it's the oil data that we've seen when there's been a mix of data the past month or so with builds and draws in inventories. But overall, when fundamentally for the economy, when oil prices climb and go higher, then it adds to inflationary pressures for the rest of the nation too, as a lot of products are made and are made using the inventories of crude, gasoline, and distillate as well. So that can have an effect, and it has had an effect on the inflation readings that we've seen. But for the release itself, that's the main thing just to consider. Then is that transportation is the big thing that is impacted. Then why is it a release to watch? So it can be a very volatile release in itself, where you can have sometimes up to upwards of nearly a $2 move on the figure itself. Recently, we've been hovering around about up to $1.32, and not to and from last week we've seen about 40 ticks, 40 tick move on the release. But that is why it's a release to watch. It can be a very volatile trade, is what I'm trying to get across to you guys. And it can be very opportune, can bring an opportunity. But again, it depends on how strong sentiment is or weak it is. So moving ahead then, other things to consider is how does it affect the markets. So when more oil is added, it's negative for oil prices. The reason being is that when there is less demand for oil, usually what happens is that there would be that would be the reason. The reason that would happen is because oil producers are producing too much or more than is demanded from countries or businesses when looking at oil. So what would tend to happen is that when you do get a build in inventories, it's negative. It can have a negative impact on WTI crude oil, and also just fundamentally as well, as said, when there is less demand for oil and prices, and there is a build in inventories, or there is a build in producers providing oil to the markets, then it's negative for oil. The key thing is a build to be aware of if you're not sure of that phrase. And then on the flip side, when there is a draw in inventories or less oil is added, when there is more demand and less available to the markets, then that's positive for oil. That brings up the price of oil in the markets. So again, you've got your build when more oil is added, and it's negative oil. And then when there is less oil added, when there's a draw in inventories, then you'd expect prices to see a movement towards the upside. So then the triggers then, if we're looking at what economists are expecting, and I know we've made a change for our forecast figure ourselves as well. So the economists are expecting a high estimate, or where they see the actual figure coming out the high end at 3.2 million, with a low estimate of minus 4 million. Gasoline with a high of 1.7 million and a low of minus 2 million. And then distillate with a high of 3 million with a low of minus 3 million. So just to be aware of then the median forecast then of what economists are expecting the data to come out as. So EI crude oil inventories forecasted to show a draw to minus 2.2 million from the prior of 2.025 million. And then gasoline inventories forecasted to show a build of 0.5 million with a prior of minus 0.812 million. And distillate inventories also expected to see a draw as well of minus 0.5 million from the prior of 2.592 million. But again, the key thing to be aware of is the headline figure itself, expecting a draw overall. So so deviation wise, if the high estimate for economists is about 3.2 million, forecast is minus 2.2 million, you're looking for about 5 mil deviation there on the headline figure itself, according to economists. And then on the low end, the economists are looking for about 1.8 million deviation on the headline figure on the low end, with the low end being minus 4 million. So that's just something to be aware of. And then if we go through some of the other stuff too, so API data is also can be very important and sometimes does have a correlation with the EI inventories data itself. Now, the good thing about this, or the attractiveness of this data, is that it comes out the day before the official data is released from the government. The API data, being private data, has had some correlation in the past where you see if API data shows a build overall or a build on certain figures, then the EI inventories data the following day could show the same direction. But that hasn't always happened. There hasn't been a very strong correlation between the API data and the EI data, or the official data the following day. So what happens, or why is it attractive, or why was it attractive, is that the day before, traders would trade the API data, and then you would see quite volatile moves, or you'd see either a straight shoot up in WTI or a shoot down in WTI crude oil off of the back of that data. So you would have traders trying to price in where they would expect the EI inventories to be. But since the Russia-Ukraine conflict, we haven't really, probably on one occasion, and that was about 3 weeks ago, maybe a month ago actually, where we did see a slight reaction to the API data, but recently that hasn't happened. Of course, oil markets have been very volatile since the invasion of Ukraine from Russia, and which has muddied the waters of how to kind of take in these releases and what to kind of expect, and how much volatility there actually might be, or whether there will be enough, or is there enough volatility to be able to trade the release itself. So API crude oil stock change data, as said, it can kind of foreshadow what to expect for the day ahead. But last night we got the data at if we'd seen a build of 0.736 million. Forecast was minus 1.2 million. Prior was 1.845 million on the crude oil stock change data. Gasoline had seen a draw of minus 2.159 million compared to the prior of 1.821 million. And then distillate stock change saw a slight drawdown at 0.234 million compared to the prior of 3.376 million. Again, as said, markets didn't react to that last night, but still kind of key to just be aware of that. If the economists are expecting a draw in inventories today for the EI crude oil inventory data, the private data last night shows the reverse of that, actually showing, okay, there was a build instead. So, like I said, not strong correlation, but has seen at some points in the past where there has been a bit of a correlation. So we could see the EIA inventories data showing a build rather than a draw. But again, it's more of a wait and see. But that's why API data can be quite important. So then the OPEC report, okay? that we had this week. So the pre-release or pre-report of the OPEC monthly report, we had OPEC said that they see halving in oil demand growth next year. I think the key thing is that they're expecting a slight, mild recession to occur next year. Hence, they would expect to see. Well, that's one reason. Hence, they'd expect to see a decline in demand. But second of all, you've had a huge amount of demand from 2021 to and also the beginning of this year as well. That has seen huge jump in the price of WTI crude oil and of course Brent as well. So that's also another thing that they're considering, is that because of that huge demand that we've seen this year, that is going to slow down and it's not going to be as strong as it is going to be as strong as it was this year. Next year instead. So they see world oil demand averaging 100.29 million barrels per day in 2022, exceeding 2019 pre-pandemic levels. But I think that's quite obvious with how there is a huge demand for oil and also other commodities such as natural gas as well, to be pumped into different countries. Of course, with Russia being the sticking point, where there being a loss of that supply, and the stigma surrounding Russia of saying if you do take energy from Russia, then you're seen as one of the bad guys. But that's what they see there, exceeding 2019 pre-pandemic levels. Also itself, so OPEC Plus, so its oil output fell by 176,000 barrels per day in May to 28.51 million barrels per day, missing target for increase under OPEC Plus deal. Reminder, they did say they would increase the amount of oil, or start increasing the amount of oil to by in total of 632k, or around 648k a day, rather than going from 432k. So they were looking to do that later on in the year, in around July, August, but then they'd pushed that, they had brought that date forward and decided to do that in June instead. June 13th, we had S&P's Jürgen making some key comments as well as to the potential visit, or the visit that we're going to be seeing between Biden and the Saudi Crown Prince when he does go to Saudi Arabia between the 15th and 16th of July, or when during his tour of the Middle East. He's also going to be visiting Israel, I believe, on the 13th and 14th of July. But yes, 15th and 16th is when Biden is expected to go to Saudi Arabia to meet the Saudi Crown Prince. And Jürgen says that the Saudis are likely to boost oil supply if Biden visits. Now, you've had a lot of these different countries, of course, the European Union, you've had the UK as well, that have been looking for the Saudis to start pumping more oil into the markets, and to do that relatively quickly. Now, there was, at the beginning, when those comments were coming through from different various governments saying that the Saudis and OPEC need to increase their oil output, at the beginning, the OPEC members and OPEC Plus members weren't looking to, be kind of tagged along or pulled by, figuratively pulled by the tie to increase their oil output. But because of the main reason is because they had seen it as there wasn't an actual loss in oil. It was just geopolitical factors that were taking effect that had caused the price of oil to rise exponentially. But then, and that was what Barkindo said, it was more geopolitical and political factors rather than oil, or the oil supply itself. Then as the Ukraine-Russia conflict dragged on, and you had more countries that were pushing against or pushing for a ban or an embargo against Russian oil and Russian energy, then that potential loss of supply and the current loss of supply that we are seeing from Russia has had that impact on the markets. We have seen the likes of WTI, jump up to around 120, around above $120 per barrel. If we're currently looking at it now, we're sitting at $117, so well above. Of course, being above $100, according to some economists, is going to make it harder to bring down consumer prices or inflation if we're including food and energy as well. But that's one thing to just be aware of, is that if the Saudis are going to have a meeting with Biden, then according to what he said, is that they could likely boost oil output. Oil demand also remains strong and supply remains weak, and the oil supply situation is razor thin. So again, tight supply, and there's a huge demand for oil. And then this interesting infographic here from OPEC 2 that I picked up on from yesterday. So world oil demand and non-OPEC supply year-on-year changes. So you can see when they talk about the demand halving in the following year, or growth next year, you can see that with the year-on-year changes in the first quarter, you've seen this huge amount of demand from the global, from the rest of the world, and that OPEC isn't able to meet that demand. Non-OPEC oil supply, showing that that's not meeting the demand that is required. So hence you'd seen comments from other countries looking for the Saudis and OPEC itself to increase oil supply to kind of fill up this gap. But as you can see, so the second quarter still seeing all the way, all the way to the fourth quarter of 2022, that no matter what, there's still going to be an increase or a large demand than there is supply, which would likely keep upward pressure on oil prices. Then 2022 overall, they're seeing that world oil demand, so the year-on-year change, seen at 3.4 million barrels per day, and then the supply again not being able to meet the demand at about 2.1 million barrels per day. So I think the key thing to remember is that oil markets, of course, it's harder to kind of gauge how much movement there is going to be from the EIA inventories release itself, and also the API data from the night before. Okay, so what's driving sentiment then? So you had China COVID situation. They implemented mass testing on Monday, and they said that so according to ING commodities analysts, they said that China's COVID zero policy remains a market risk. That I think that's very obvious, that when China goes into or has these mini lockdowns, that it has a negative impact for oil, as there is a loss in demand, particularly if we're thinking about the Russians, that China and India are the two biggest clients of Russia. So the loss of potential demand from China doesn't really add to the positive. It doesn't have a positive tone to it. It has more of a negative tone for WTI crude oil. But to be fair, the China COVID lockdown news hasn't really impacted the markets that much. And I think the main key thing is that you've had other bits of news too, such as when we're talking about sort of tight supply and demand. So Gazprom, they're reducing. They said that they would start reducing their flows through Nord Stream, key pipeline bringing Russian gas to Europe by 40% due to technical issue at its Baltic station, which was exacerbating the continent's supply concerns. So this bit of a war really in prices and providing energy, and the European Union being very reliant on the Russians. Okay, is very brinkmanship commentary and actions being taken by the European Union to put an oil embargo on the Russians, to kind of phase out Russian energy by the end of the year, and also phasing out crude, natural gas and crude by 6 months, but I believe in total by a year. That's that's also helped keep upward pressure in the oil markets too. So that's one thing also to consider. And then for following on, so it says Biden and Saudis, that's to what they recently said is that they did confirm a couple of days ago or yesterday that the meeting between the Saudi Crown Prince and Biden would take place between mid-July to discuss energy production. So from those headlines, of course, when there is more oil created, as I said, that's to try and satisfy demand, then you would see a depreciation in oil prices as more oil is pumped into the markets to try and alleviate the upward pressure that we've seen so far from that asset. Then the other thing to point to as well when we're talking about Russia and its supply and who's taking up this Russian energy. So close to half of Russia's seaborne crude now goes to Asia. So you can see before the conflict here that the majority of that seaborne crude was going to Europe and other nations, and you can see probably from what I can see there that's about 2 million barrels per day going from Russia to to Europe, and then of course when the conflict kicks in and you have the talks of potential oil embargoes and embargoes on Russian energy, then you have that Asia becomes the biggest supplier or biggest importer instead. Remember from the Baltics, with these seaborne products that are going from the Baltics, some analysts say that it takes about 60 days for that to be transported. So that's a lot of time, and that's a lot of fuel being spent to send fuel to China and the likes of India as well. But that's what we can see, that there is, because of that loss, because Russian energy has been shunned, that's also helped to keep upward pressure in the oil markets too. If we're just looking at an overall market reaction or market moves, then trying to see how long it's been since we've stayed above $100. Okay, so back on around May the 11th or May 10th, we've been above the 100. We've been above $100 per barrel on WTI crude oil. So again, there's strong upward pressure in the oil markets overall. So let's go. We've got about 7 minutes, so let's go through the previous release and see how the markets reacted. So the data. So we've got about a second left. It comes out. It showed a build in the EI crude oil inventories. You did see that move towards the downside there. So there was an overall build in inventories. Now the market reaction. So we'd seen about 4.5 million deviation on the headline figure itself. Okay. So we'd seen an initial 39 tick move towards the downside and then 38 ticks up. And then after about 10 minutes, we had seen about 30 ticks up. So if I just bring this across to you here, so if I just put that there so you can still see the chart to the previous release. So showing here, as said, there was we had pushed our trigger. Instead of looking for 8 million, we were looking for about 5 million deviation on the headline figure itself, and the other bits of data to kind of support a potential build or draw. Of course, it was slightly mixed. We'd seen, you did see that we were more or less near enough to our 5 million deviation. But even so, although we did get that initial move towards the downside, there was this choppiness that came into the market. So the candle finished positive on the first one of what we had seen. So it didn't really hold up well, it wasn't really enough for WTI crude oil to stay down on the first candle and not see that move. So I think from what we've seen, and I think the main reason why we switched to about 5 million of a deviation is because the prior release that we had on the 2nd of June, where there was about a 3 million deviation, we'd seen about 87 ticks towards the upside on the first candle. And then that held, it didn't reverse. It didn't reverse at all. And then after about 10 minutes, it was up by about 96 ticks on after 10 minutes of trading on the 2nd of June. So that's why we kind of brought down our deviation and our own triggers ourselves. But last week, I said 5 minute deviation. Yeah, for the initial reaction, like I said, you did see that initial move towards the downside. But I think I think we want to go between an 8 million and 5 million. So probably around a 6 million deviation either way on the headline figure itself. Okay, whether it's a build or draw, to get a stronger reaction in the direction that the markets are expected to go. So here you go. So more or less you had sentiment that kind of took over, and it was a very choppy reaction that you'd seen. So it wasn't really nice to trade if you were trying to trade that release. But anyway, so we've got about 3 minutes left. This is available. This data here, the deviations, is available to our mailing list subscribers who are able to look in the data in a bit more detail and kind of prepare themselves a bit more rather than me kind of rushing through it here. And you can kind of test what yourself, what you're looking for. So that was the reaction there. So there was an initial 39 tick move towards the downside with less than a 5 million deviation on the headline figure. Not all of the bits of data were pointing in one direction. If we did see all data point in one direction, then what I would have hoped for, oops, if I just kind of escape that. Close it there, bring that out of the way. Let's bring you in. So usually what I would expect is that all the bits of data, if you want a stronger reaction, all the bits of data would go in one direction. If we're expecting a build or if we're expecting a draw. You wouldn't want a mix of data in the markets. I think the key reason being as to what we'd seen last week when there wasn't an outright move, or there wasn't a clear, there was choppiness on the first candle. So we got about over a minute left. We're looking for about 6 million deviation on the headline figure itself to get a good, strong reaction. And we'd want all the other bits of data to show, to move in the same direction as the headline figure itself as well. So I've got Tickstrike here, I've got my crude there. Okay. Got a minute left. Okay, got less than 10 seconds to the release. That's 1.956 million, 1.956 million. That's a build on the inventories of minus 2.2 million. Okay. It's interesting. What's going on there? So, that's because I got it in the daily. My bad. Okay. So we did see that move towards the downside then. So overall, showing a build in inventories. So again, headline figure showing 1.956 million, 1.956 million, build on the forecast of minus 2.2 million. Gasoline inventories minus 0.71 million, minus 0.71 million, draw on the forecast of 0.5 million, and distillate inventories showing a build of 0.725 million compared to the forecast of minus 0.5 million. Again, did see the initial move towards the downside. Let's measure this now, see how many ticks we got. If we go there. Okay, so there's about 45 ticks, or about 44 cents move towards the downside on WTI crude oil. Didn't see our 6 million deviation on the headline figure, and then the other bits of data to kind of back that up. But if we just measure the deviations as we have them for now, let's bring this in. Okay, so we had on the crude oil, on the crude headline figure, we had about 4 million deviation there. Gasoline, you check that too. Distillate. Okay. More or less it's the same what happened last week in regards to the actual figures. So let me run through the numbers again then for you. So the deviations are what we had. So we had a 4.1 million deviation on the, ignore the ticks there, that's the new ones. So we had a 4.1 million deviation on the headline figure. Okay. As I said, it didn't meet our 6 million deviation on the headline figure itself, or our old trigger from last week, about 5 million deviation. The gasoline inventories showed had seen about 1.21 million deviation. Distillate about 1.22 million deviation on the figure itself. Between the difference between the forecast and the actual. So, not a clear direction. As I said, we'd wanted to look for all the bits of data to show going in one direction to get a stronger initial reaction, or to hold, or to see if we did see a build, we would have expected a build on all the bits of data for WTI to kind of hold its move towards the downside. Although it isn't as compared to last week, it isn't as choppy. It's still, we can see, did move back above its release levels, but now heading further down. So again, still hasn't cleared that initial wick we'd seen towards the downside. Okay. So I think this is kind of cementing probably around 5 million, 5.5 million deviation then on the headline figure itself. If we're getting figures such as a 4.1 million or around a 4 million deviation, we're seeing negative ticks there for the back of it. But really, I would have wanted all the bits of data to show a movement, a build in inventories, rather than one figure standing out showing a draw. So you don't want to mix the data. You want all bits of data going in one direction. Of course, that didn't happen. So 44 ticks there. So this is on the initial candle going to the wick. 44 ticks. So that's the first. So it's 44. And then what I'm going to do is what I usually do is I'll mark the initial tick, or initial wick, and then I'll go what the candle was, the high point of the candle. Oops. Okay, so I've seen about 20 ticks towards the upside. Okay. Alrighty. That is a release there. If you do have any questions, feel free to ask me any of those questions and let me know your thoughts. If there's anything to kind of improve with the service we're providing here, then do let us know. But hopefully you did kind of see it on your own chart. Maybe not. Of course, apologies, I didn't stick it to the 1 minute candle on my chart at the release. But if you did see it, then you would have seen that the actual figures itself came up pretty quickly on the Financial Juice news feed, and that's on the pro version. So one thing to consider is that a Squawk service, if you're familiar with Financial Juice, if you're on the light version, it provides you with real-time voice and text headlines. Okay, so the light version doesn't do that. There's a delay to the service there, but the pro version allows you to listen to and read headlines in real time. So what I will do here is we want to provide you with a 7-day free trial of Financial Juice Pro. The key thing is why you want a real-time news service is, I've put the link in, by the way, in the chat. The key thing is that investment banks use a Squawk service to manage their risk and jump on any trades or potential trades that they could see from headlines that come through. Okay, we want to think about the and also economic releases too. You want live data, real-time data, to be able to see those occurring. So you can get that with Financial Juice Pro, as you can currently see what I'm using here at the moment to be able to do that. Also as well, you can put in your own manual triggers for economic releases. So and that's also real-time too. So ignore the number here. That's just the forecast figure, not us telling you what to do. But you can add in your own figures as well. So if we were saying for crude oil, if we wanted, I'd sell if it was greater than, let's say around 8 million. Okay, let's say 8.2, and then buy if we'd seen. Whoops, I can't see the prior there. Hold on. There we go. If we, and then whoops, that's there. Let's say I just buy if we get, I don't know, -8, just for now. And what they'll do is that when the release comes out, to the dot, to the second, right? As soon as a figure comes out, you'll get an alert saying whether to buy or sell, depending on what trigger you've set, on the dot when the figure comes out. And that's in real time, whereas in the live version, it's not. So that's another benefit of Financial Juice 2, having Financial Juice Pro. You get no adverts, no delays to the website, and you can receive economic triggers in real time that you set yourself when the data comes out. So, hey, there we go. It's continuing to go down, baby. All right, so that's Financial Juice Pro, and I've put the link in there. Also, Tickstrike, you can see that going off at the moment when there's a lot of selling going on here. So what Tickstrike does is it represents order flow, and you can see that here on the ticker that I have for crude oil. You have your different levels, so you can set the level of sensitivity. One is the most sensitive, so when there's a little bit of buying or selling going on, and it meets any sort of buying or selling that kind of goes on, and it meets the triggers for your level, then it will kind of go off. As you can kind of see now, there's a little bit of buying going on. The Tickstrike is showing you a visual, and it can also allow you here with an audible alert too. Of course, I've got the turn off at the moment. But you can change your level of sensitivity. So one is the most sensitive, when there are little bits of movements going on in the markets. And then as you decrease the level of sensitivity and you go to 15, 15 is the least sensitive. So only when there are big moves going on in the market or a lot of momentum is what you've got to bear in mind, as simple way to kind of think about Tickstrike. When there is a lot of momentum, either buying or selling with Tickstrike, with a certain asset class, then only then will the alert kind of go off for you. So if you're a scalp trader, if that's your kind of thing, you kind of capitalize on opportunities in the markets, or you want to manage your risk during the day, then Tickstrike is there for you. And what we want to do is, of course, Tickstrike, there are a multitude, there's a plethora of different assets that you can also have a look at too. Not just crude, you've got your currencies, your futures, of course, commodities and stock indexes as well, your bond futures as well, and stocks themselves, ETFs, ETNs, crypto. Like I said, there are a lot of different assets that you can look at and that Tickstrike covers. So the best way to kind of be able to experience Tickstrike yourselves is to have a 7-day free trial of Tickstrike, which I've just put in the chat for you. Scotch and Stock says, you guys planning to bring back the one-time fee for the service? Are you talking about Financial Juice, or are you talking about Tickstrike? But if you email us, if you email the support email at Amara Financial Juice, or for Financial Juice. So if you email Amara Financial Juice, there isn't anything at the moment, but have a little word with Amara Financial Juice. He can kind of talk about that with you there and go through that there. So email him there and have a little discussion. But yes, so if we're carrying on then, so that's Tickstrike there for you, 7-day free trial. And then, of course, if you liked this video, then don't forget to like it, share it, subscribe to the channel. Also, give us a follow on TweetDeck as well. So MacroRace, that's the link there for you to be able to use. And the mailing list, which is quite key. So every Sunday, I'll be putting out the what to expect for the week ahead. Okay, so I've got that here for you. So let's move that out of the way. So this is the kind of level of detail that I provide for you guys of what to expect for the different sessions. It's for Asia, Europe, the US, the releases that we'll be covering for the week. And of course, we've got the FOMC at 1 p.m. Eastern time, an hour before the release. So I'll be covering that there, but I go into a bit more detail, as said, about some of the economic releases, some of the news that we've seen as well, and what to kind of expect too. And then a summary of the weekend news as well. So that's there for you. But on top of that, one thing to note as well, that the deviations then that you'd seen here for the economic releases, a PDF version is also provided of that as well. But remember, well, if you're looking at this little bar here, you can see that I cover a load of different releases, mainly the big important releases that I post on the that I post for you guys in the mailing list. So that's sent out every Sunday, and you also get to see the previous videos too in a playlist, rather than sending a video to you every day after the releases has occurred. And then you also get a playlist for the economic releases for the week ahead as well. So it's one email every week on the Sunday that I send out to you guys to take in that information. So the mailing list, you can subscribe to that here. Ooh, I already have the chat. That's the link there. Scotch and Stock says, I'll see you back for the CPI. Okay, all right. I'll see you then. But yes, so there we go. That is all. If there's any questions you guys do have, do feel free to email me at tony@financialjuice.com for any questions or anything you want me to improve or add to the service. And then, yeah, we'll go from there. Other than that, thank you very much and goodbye.